Hello and welcome to the look ahead for Wednesday, the 17th of April, with me, Fiona Cincotta, Senior Market Analyst at City Index. So, tomorrow we've got kicking off UK inflation data for March. We've also got inflation data from the Eurozone, although that will be the secondary reading, the final reading for March. So, it doesn't tend to be as market moving, if at all. Also got from the US the Fed Beige Book and for earnings from ASML and also Adobe. Now, I think the main focus, as I said, is going to be on UK inflation data, which is expected to cool to 3.1%, down from 3.4%. Core inflation is also expected to tick lower to 4.1%. So the data is really expected to confirm that, UK consumer prices are on the trajectory towards the Bank of England's 2% target, although not quite there yet. Now, the data comes after UK jobs data today, which was a bit of a mixed picture. We saw that unemployment actually ticked quite a bit higher to 4.2%, and that was unexpected. And we also saw that wage data cooled, but by just a modest amount, to 6%, down from 6.1%. So, we're definitely seeing some weakening in the labour market because of those tick higher in unemployment numbers, which suggests that the economy could be weakening, but that's not yet coming through in those wage figures, which the Bank of England will want to see come down before they really think about cutting interest rates. So I think, as far as rate cuts are concerned, the market's still pricing in 2 interest rate cuts this year, with the first one being fully priced in August. Now, that's quite interesting because it differs quite a lot from the US, which is why we've seen this steep sell off in the pound US dollar chart we're looking at here. Obviously, we had that hotter than expected inflation last week, third straight month of increasing inflation. And also, that's seen the market really push back on Federal Reserve interest rate cuts. With the first one not being fully priced in until September now. So back really quite significantly. Now, that's obviously strengthened the dollar. We also had, retail sales data came in yesterday, which is also stronger than expected, highlighting again the resilience of the US consumer and therefore the US economy. And that's keeping the dollar really well supported up at 5-month highs. Now, if we just have a look at this chart here, as I can see, as I said, we've got the pound US dollar. Now it's trended lower. We can see that series of lower highs and lower lows. Basically, the line in the sand at the moment for the sellers is going to be 124. That's the April low, which was touched today. That's going to be a sign that sellers are going to want to break below in order to test the 123.20 level. Now, that was the May low from 2023. Any sort of recovery is going to need to get back above 125 and then 125.80, which is the 200 SMA. Now we've got a similar pattern going on here with the euro US dollar. Really quite a steep sell-off over the past couple of sessions as far as the euro US dollar is concerned. It's trading down, or fell down to 106. That was the 2024 low that we saw hit today. Basically, sellers are going to want to see that broken down. And again, it's a similar story as far as the euro is concerned. We've got inflation data tomorrow that's expected to confirm the preliminary reading of 2.4%, which again is, going towards the ECB's 2% target. And yet in the US, we're getting that hotter than expected inflation, which was up at 3.5%. And we've got the strength of the US economy, whereas the Eurozone economy has, suffered quite a lot more. It's a lot weaker. Although I have to say, we have seen some signs that things are starting to turn around as far as the Eurozone economy is concerned. German data today showed that ZEW economic sentiment was much stronger than expected, up at a 2-year high. And that's as inflation has cooled in Germany back down to 2.2%. So it does look like things are really starting to turn around there. Again, that's going to be a slow process, though. And we've got the euro US dollar would need to take out that 106 level to get to 105.30. That was the March 2023 low. Below here, 104.50 will come into focus. On the upside, buyers are going to be looking for any recovery, really will need to retake the 107 level in order to retest the the 107.25. That was the February low, and then we've got the 108.35. That's the 200 SMA there. But still that chart's looking quite bearish. Just watch out for the RSA, which could be tipping into oversold territory soon. So let's just have a look now. This is the S&P chart that we're going to pull up. We've got earnings season ramping up. We've had the banks reporting earlier today. We also had them reporting yesterday and at the end of last week. Broadly speaking, the ones today, we had Bank of America, and we also had Morgan Stanley, better than expected. Also with Goldman Sachs, we've seen this revival and recovery in the investment banking business, which has helped them. So, earnings season's been off to a mixed start, is what I'd say, but still very early days, really, with just the banks in so far. Looking out across the week, we do have Netflix later in the week. But what we're seeing here is the S&P has come under quite a lot of pressure, because we've seen that rise in US Treasury yields up to a 5-month high on expectations that interest rates are going to be staying high for longer. Federal Reserve Chair Powell is due to speak any moment now. We saw San Francisco Fed President Mary Daly yesterday saying, at the end of the day, the economy is strong, it's growing. The inflation is still above target. So actually, there is no urgency to start cutting rates. With that sort of prospect of high rates for longer, then combined with sort of, some geopolitical tensions in the Middle East, is just sort of creating that risk-off environment for stocks. As far as levels to be watching, we've got the S&P 500 is just testing 50.40. That's the low for this week. It's touched that today. In fact, a break below here is going to test it'll bring the 5,000 into focus. And below that, the 49.30, the 100 SMA. If we do find that we can get some support in there at the 50.40 level, the upside, we're going to be looking for a break above 51.50. And then the 52.30. That's the sort of range that the S&P had been trading in over the past few weeks. And just finally to mention, we do also have tomorrow oil inventory data. I think it's just a good idea to keep an eye on oil with all the tensions in the Middle East. Now, we've had the attacks by Iran on Israel over the weekend. We're still waiting for Israel's response to that. The ball is very much in Israel's court as to whether tensions in the Middle East get ramped up further, or whether they're going to sort of simmer at these levels. And that very much depends on whether we see a counterattack from Israel. We know that the US has said that it won't support a counterattack, but we don't really know whether that is necessarily going to stop Israel from making a move. So all eyes are very much on the Middle East, Iran being the third largest oil producer in OPEC. So obviously, any sense that there could be sort of disruption to supply could push oil prices higher quite quickly. Now, if we just have a look at this oil chart here, we can see that it has been trading pretty range bound, I would say, over the last the last week or so, after hitting the high of 87.75. That was a 5-month high. And it's been capped on the downside by 85 now. So we'll be looking here for a breakout, potentially more to the upside, given where momentum's been taking us so far. If we get a break above 87.75, that's going to bring $90 the barrel into focus. On the downside, if we get a break below 85, that's going to bring 83.10 into focus, and below there 80, which is the round number. So I hope you like what you have seen, and if you do, then please do give this video a like, and if you would like to receive more videos like this, then please do follow. Thanks very much.